we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
This is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, I mean, we've been in a bull market since 2000, but there've been major pullbacks. Right, this is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the oil, the lockdowns when oil went to negative 35, so that's why it went so high here. But like we're about halfway up this spike when the lockdowns happened, when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now. What I'd say about this is that we are coming up on a hard wall here. I mean, I'm trying to figure out how to phrase this because lowering interest rates can only expand the money supply on a commercial banking level. It doesn't expand the monetary base. If we're going to get into how the plumbing works, I don't know everything about how the plumbing works, but I understand this at least. The lowering interest rates will only encourage more loans from the commercial banks, but it can't increase the monetary base on which those loans are made. And the monetary base is the amount of money that isn't being loaned out and instead is earning interest by the banks from the Fed is still like over $3 trillion. So lowering interest rates is not going to increase the money supply because the commercial banks, if they wanted to make loans, they would make it with the bank reserves that they already have, right? But they're not. So at this point, when you have what do they call it? A tight reserve system. They have it's like there's three words. There's like something. There's ample, and then there's like these three adjectives that they use to describe a regime of reserves. And what we were in before 2008 was like a tight reserves regime. So in that type of monetary system, yeah, lowering interest rates would increase the money supply because banks would make more loans because it would be easier to make them because interest rates are lower. So then you have more money supply. But in this environment of it's ample versus abundant. I'm not sure which one's more. So it could be that abundant is more ample than ample, or ample is more ample than abundant. I don't know. But it's not going to affect the money supply. It's just going to keep going on the trajectory that it was going until the plumbing hits a wall, which should be in the next few weeks, or any week now, because the amount of reserves is just about equal to the amount of repos that are being traded every night now.
Reserves and repos, the overnight lending that keeps markets liquid, are now nearly equal in scale. This suggests we're fast approaching a hard wall in the system's plumbing. Once reserves are strained, market participants could lose confidence in short-term funding stability. Historically, such cracks precede financial turbulence. The Federal Reserve insists conditions are ample, but the difference between ample and abundant is more than semantics. It's about whether markets truly trust liquidity. If confidence wavers, the result could be a rapid escalation into a bond, interest rate, or even currency crisis, shaking the foundation of today's global financial order.
So I think the bull market, if you like, if we could call it bull market in precious metals, continues until such time as the currency has to be replaced by sound money. So how long does it continue? I think at best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event. But these things come along and they'll be pushed into a situation where People are running to the shops to get anything which will preserve its value. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
In times of uncertainty, investors historically turn to tangible assets. Gold and silver are once again rising, supported by central banks themselves, who in 2024 and 2025 became net buyers of gold at record levels. Nations like China, Poland, and Turkey are stockpiling bullion, preparing for a potential reset of the monetary system. The reasoning is simple. Government debt is ballooning, inflation erodes purchasing power, and fiat currencies are under strain. Until a new system, whether a digital dollar, gold-backed currency, or central bank digital currency, CBDC, emerges, precious metals remain the ultimate hedge against systemic risk.
This is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, and we've been in a bull market since 2000, but there've been major pullbacks, right? This is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the oil, the lockdowns when oil went to negative 35, so that's why it went so high here. But like we're about halfway up this spike when the lockdowns happened, when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now.
Banks, when they lend money for a mortgage, whether it's in the UK or any other country, they are effectively lending that money out for the next 20 or 30 years because they're not realistically expecting anyone to repay the mortgage in the next 6 months. So, of course, long-term rates have to have an effect on the interest rate they're going to charge you on the mortgage. Yes, there's an influence in the UK because they set the rate in some way to the 2 or 6 or 5 year term, and then it gets rolled over at a higher rate regularly. But at the end of the day, if long rates are pushing higher, the banks have got to have their heads screwed on and say, well, we've got to charge our customers a little bit more, because at the end of the day, the alternative, we don't have to lend the customers the money on their mortgage. We could go and put the money into a 30-year bond, which is effectively the same thing, instead of lending it to my customer. So if the 30-year bond rates were to go to, say, 7%, you won't be able to, I don't think you'll be able to get a mortgage for less than 7, for sure.
History shows that monetary resets follow crises, whether wars, defaults, or black swan events. Each time, currencies are devalued or replaced, often leaving savers with less and those holding gold with more. The 1971 closure of the gold window, the 1997 Asian crisis, and the 2008 meltdown all reshaped how money flowed through economies. Today, with global debt surpassing $315 trillion, the system appears stretched beyond sustainability. Investors sense that another tipping point is near. Gold's bull market, which began in 2000, has weathered pullbacks, but the underlying driver, debt expansion, remains unstoppable, suggesting the climb is far from over.
Basically, what Clive is saying makes logical sense. If a bank can lend the money to the government with much less risk than it can lend to somebody for a mortgage, with a much lower default risk to the government, obviously, then whether 30-year mortgage rates officially set mortgages or unofficially doesn't make that much of a difference. It makes a little bit of a difference, maybe in short-term fluctuations and stuff, but there shouldn't be too much of a spread between 30. There shouldn't be more 30-year mortgage rates shouldn't be substantially lower than 30-year bond rates. It shouldn't be lower at all. But if it is lower, it shouldn't be that. It definitely shouldn't be that much lower. So yeah, their mortgages are set by long-term rates, either formally or informally.
An intriguing shift is underway. Gold mining stocks are finally outperforming gold itself. For years, miners lagged behind, burdened by inefficiency and poor investor sentiment. But in 2025, their performance has surged past not only gold, but also the Dow, S&P 500, and even Bitcoin. The sector remains small, worth under $1 trillion compared to giants like Microsoft at $4 trillion, so even modest inflows move prices quickly. This suggests a broader awakening among investors. When miners lead metals, history shows it often marks the beginning of a powerful bull market. The forgotten sector may soon capture global attention.
Gold is not really an investment. I agree with him on that. I think it's a divestment. The question is when you're trying to increase your wealth in stocks and bonds and whatever else it is that you want, the stuff that you're not investing, are you going to have dollars or your currency or 30-year treasuries or whatever, or are you going to put your cash in gold? And in I guess stable times, then you wouldn't want gold. You'd want cash because it would be more liquid and you'd earn I don't know, a small return on it, whereas in gold you wouldn't. But in times like these, when the inflation cannot be stopped, the inflation of the money supply cannot be stopped, and the devaluation of the currency, which is essentially a gold derivative anyway. If you own the currency, you own bonds that are going to be defaulted on one way or another. So if he is an investment manager, I'm not disagreeing with Clive, but just to put it in different language, yeah, investment managers usually don't have any gold because gold is a divestment from the financial system. It's not an investment in it.
I mean, there's been a sea change in the behavior of gold mining stocks relative to the gold price. We've been through some decades, at least a decade, where the gold miners have been a big underperformer. Gold's been going up, stocks have been going up, and the gold miners have been the dogs of the world. But starting from around the start of this year, gold miners have been outperforming significantly the gold price and outperforming the Dow, the S&P 500, and funnily enough, NASDAQ too. So in fact, they've also outperformed Bitcoin this year. So the money is drifting, and don't forget the sector is tiny. It's like 600, 700 billion dollars compared with, say, a Microsoft, which is $4 trillion. So only a tiny bit of money is drifting into that sector, but it's pushing the prices higher almost day by day this year.
As technology giants dominate headlines, their lofty valuations contrast sharply with the undervaluation of gold miners. Tech stocks trade at 30 times earnings, while many mining companies sit closer to 10 or below, ratios that will likely fall further as gold prices rise and profits expand. For now, few investors notice. Yet if confidence in equities fades and panic selling sets in, capital may flood into precious metals. The transition won't be smooth. There may be volatility, but the direction seems clear. The age of monetary experiments is running out of road, and gold is preparing to reclaim its central role.
I think that when miners lead the metals, it means that that means that the bull market is just starting. And I think that's what's going on now. And miners have been hated for so long that still there's almost nobody in the sector. If you ask anyone who has a stock portfolio or even talks about, do you have any gold or silver miners? They're like, what, are you crazy? No. But I mean, I really want to see what's going to happen to the gold and silver miners and the streamers and all those other stocks. What's going to happen when the Magnificent Seven and do they still call them the Netflix? What do they call those? They had an acronym for them.
You think of the FANGs?
Yeah, the FANGs and Nvidia and all that. When they really start to fall, and people really start to panic, then what's going to happen to the gold miners? I think they're going to go down, but I think they're going to go down very, 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 very relatively minorly down. They might even go up. I don't know. I mean, if money panics out of the tech stocks and into gold, if gold is heading higher on some kind of realignment, then you could see gold mining stocks and silver mining stocks go up, even if tech crashes. I don't think it's going to happen, but I think it's possible.
By and large, the gold mining and the silver mining stocks are relatively cheap. If you look at the price earnings ratio for the current year, 2025, you'll see that many of them are trading at price earnings ratio of close to 10, some below, some a little bit higher. But there's a huge difference between the price earnings ratio of these gold mining stocks. So a low price earnings ratio means relatively cheap, and the very high price earnings ratios we're seeing in the FANGs and the Mag 7, where the ratios are typically well over 30 times earnings. So 30 times earnings means if you buy a stock, you might have to wait 30 years before it earns what you paid for it. 10 times earnings means RP of 10 means you might have to wait 10 years before it earns what you paid for it. But of course, the advantage of the gold shares is the one thing which they're selling, which is gold, it has risen in price since they calculated those price earnings ratios. So if you see a price earnings ratio of 10 on a gold mining stock now, it means that probably next year the price earnings ratio is going to be 7 or 5, because the profit they're going to make will be much higher due to the fact that the price of gold has risen since they calculated or last calculated that price earnings ratio. So the value of the value of gold mining stocks is incredibly cheap compared with every other sector of the market, and yet nobody's woken up and realized it yet. But I can see, because the index of gold mining stocks is rising faster than everything else, some people have woken up, but it's still very small money, and it's still very, very, very early stages.